Hi, my name is Andrei Jikh. Hope you're doing well. Hope your face is doing better than mine. And let's talk about investing in the stock market. Whether you love index fund investing or if you love passive income with dividend stocks, this video is really important because if 2020 couldn't give you enough anxiety, this just might. Because on December 18th, 2020, we're gonna get something called Quadruple Witching Day. And it's a really interesting concept that generates a lot of fear, excitement, and anxiety, and it's definitely something you should be aware of. But remember back on March 20th, it was a Friday, that was when we had Quadruple Witching Day. And it was that Monday, March 23rd, when the stock market hit its all-time low of the year. So things are gonna get really interesting. By the way, this was brought up to my attention by my Discord channel, where we talk about all things related to investing and sometimes Yu-Gi-Oh! And Pokemon, so I will leave a link down below where you can join for free. And specifically, I want to thank a member by the name of Jarvik, who I am convinced is secretly a James Bond villain, part-time. So let's talk about it. And you can think of Quadruple Witching as sort of like these $400. So check this out. Stock index futures, stock index options, stock futures, and stock options are basically contracts that investors put $100 into at a time, only to realize that this $100 would be turned into 4 singles. I'm just kidding, that's not Quadruple Witching. That's our Wall Street bets in a nutshell. Let's get started. So first, I want to explain exactly what this is, followed by what's going to happen on December 18th, 2020, why it's important, and what I'm doing to prepare for that day. So if you're like me and you're wondering, why is it so ominous and what's it got to do with witches? So the reason it's got its name tied to witches is because in folklore, witches were known to experience a burst of power for a short duration of time. And as you're about to learn, the Quadruple Witching Day is the most powerful, if you will, during the last hour of the trading day. Now before 2002, before we added single stock futures, it was called the Triple Witching Day, and that was just to pay homage to the 3 witches in Shakespeare's play, Macbeth. Who would have thunk it? Never thought I'd use anything I learned in English class, but here it is. And here's exactly what it's gonna do. It's basically when stock index futures, stock index options, single stock futures, and single stock options all expire at the exact same day. And like I said before, it's usually the last hour which sees peak performance of price volatility and price movement. And this event happens once every 5,000 years. No, I'm just kidding. I didn't mean to scare you, just finished watching The Fifth Element. But actually, it's an event that happens pretty frequently because it happens 4 times a year and it falls on a Friday, which is another reason why or how it's got its spooky name. But this one happens on the 3rd Friday of March, June, September, and December. And on December 18th specifically, we're gonna get our last Quadruple Witching of 2020. So let me break it down and show you exactly what that means, what's going to happen, starting with the 4 different asset classes. First, stock index futures expire. Now it's important to understand when I say futures, I'm not referring to investments because futures are derivatives in that they derive their value from something else, like an index. And when I say index, I mean a set of parameters that we look for. So for example, the S&P 500 index is an index that looks for the top 500 companies in the US. And we could create our own index of dividend stocks, let's say, that pay us 4% per year, that have paid their shareholders 10 years in a row consecutively, that have grown 10% per year, that are somewhat cheapish with a PE ratio of 20 or less, and a payout ratio of 60% or less, and call it the Andrei Jikh Dividend Index, and people would buy into that. Also, I could create an index looking for a specific girl who's 5'5", a brunette, dark eyes, kind, loving, beautiful, call it the Corey Index. So just understand that there's no single main index that people use. There are several popular ones that you've probably heard of before, like the S&P 500, like the Dow Jones, like the NASDAQ. Oh, my index finger just cracked. So those are what's traded. Now, when it comes to index futures then, it looks at the predicted value of those indexes based on a future specific date. And that's why they're called futures, because they're trying to predict the future. Now, the second thing that's gonna expire are stock index options. So stock index options options, just like futures, are derivatives and not actual investments themselves that you keep in your account. Instead, they're basically bets or contracts that try to predict where the market's going to go. Except, unlike stock options, which look at individual companies, and you might have heard of these from Reddit Wall Street Bets where they always talk about Tesla, instead this one looks at indexes. So remember, indexes are nothing more than just a set of rules or parameters that we've created, and then it tries to predict where that specific market is going to go. Now the difference between options and futures though, because they totally sound the same right now, and this is going to be very oversimplified, is that options contracts give people the option to trade with other people before their expiration dates. And this is where futures come in, because as soon as you buy a futures contract, you're basically locked in and you have to go through with your original bet. It's basically like being married, because no matter what you do and you try to throw away that ring, it's gonna come back to haunt you in the end. Stupid. But anyway, on Quadruple Witching Day on December 18th, that is the second thing that's gonna expire. So the third wave of these expirations are individual stock futures, which remember are just individual stock contracts that are expiring and not actual indexes, which are baskets. The fourth thing that's gonna expire are individual stock options. Same exact premise, instead of an index, it's individual stock options. Okay, so now we've set the stage. If you're an investor in the market, things are gonna potentially get really interesting. On December 18th, we're gonna see more volume, volatility, and basically price movement up and down. So don't be surprised if you wake up on Friday, December 18th, look at your stock portfolio to realize that the prices are all over the place. It's pretty normal, but you need to know two things going forward. The first is what is actually gonna happen, and the second is what you can do about it, because I do think there is something useful you can do, which I'll show you step by step. So here's the first thing that is going to happen specifically on that day. Just like my ex-girlfriend, looks pretty, does nothing. I'm just kidding. So there's no evidence or research that I have ever found that shows that specifically on that day, the stock market is going to rise or that it's going to drop. So the truth is you could probably sleep right through the event and not notice anything has happened. But for me on that day specifically, there is something I am going to do with my investments. And you could choose to do the exact same thing, or you could choose to do nothing at all. But for me, I'm gonna be selling my stocks. Don't worry, I'm not gonna sell all of my stocks. I'm still a very boring long-term passive income dividend investor. But I think that day specifically on December 18th, it's gonna be a great time for me to do what's called tax loss harvesting, which is a way for me to sell off some of my biggest losers in my stock portfolio to try to get some tax benefits. And I think that day specifically is gonna be a really good time to do that, because if the stock market trends higher that day because of all the volatility and the excitement, then great, I get to sell off and make a little bit of money on the side. But if the stock market trends lower that day, then I get more tax write-offs on the back end. So let me show you which stocks I'm selling and why. So first, don't judge me. I bought some of these stocks way back in 2014 when I was a younger lad. So I'll show you my 6 biggest losing stocks. Let's get right into it. This is my spreadsheet portfolio, by the way, you can get in my Patreon link below. It automates your investing and shows you some stuff automatically. It's pretty cool. So starting with BP, which is an oil stock, I'm down 40.72% on that one, or $1,059. That's because energy and oil got crushed this year, and I have plenty of oil stocks, so I'll trim this one for now. The second one is CLDT, which is Chatham Lodging Trust, and that's a real estate stock, and their free cash flow payout ratio is 672% in the last 12 months. Now what that tells me is they don't have enough cash flow to cover paying people like me unless they borrow money. And that's not a stock that I want to have my money invested in over the long term, so I'm just going to get rid of this REIT stock. The third one that I'm going to sell is GEO, which is down only $300 for me, but 53%. So this is one of my least favorite stocks that I own, just because I've learned that since investing in it, it's probably one of the least ethical stocks in my portfolio, just because now I don't believe that the prison system should really monetize people's lives. But hey, you learn as you grow older. The next one I'm going to sell is SKT, which is Tanger Factory Outlet Centers, and they are down 51% or $287. So again, another roughly $300, and they are a mall. So I think that malls are not going to do really well over the next few years, just because most of them are probably going to be converted into Amazon warehouses, with the exception of a select few. But this is a good reason to dollar cost average into the market, because if I had just spent thousands of dollars on some of these stocks, I would have lost way more money. So it's just a good case example not to go in all at once and to invest over a period of time. The next one I have is KMI, which is Kinder Morgan. They actually cut their dividend 4 years ago and the price never really recovered because of it. So I'm down 60% or $1,366, which is pretty substantial, unfortunately, but hey, energy. And the last one I have is Wells Fargo that I'm selling, which is 41.51% down, or roughly $619. Now altogether, this is about $5,000 worth of losses. And from here, there are two things I can do to really benefit. The first is I can use up to $3,000 of that as a tax write-off for this year, and the rest I can carry the balance over to the next year. And because I'm in the highest tax bracket of 37% this year, that is theoretically 37% off of $3,000 that I don't have to pay. And that would be $1,110 of taxes that I save. And that is money I could use to reinvest back in the market by rebuying the same stocks or buying new ones. And if I rebuy the same stocks, remember I have to wait at least 30 days after selling them because otherwise I would risk breaking the wash rule. The second thing I can do is do what's called a free step up in basis, which is a really cool concept. So let me try to explain what it is. So in addition to selling off my $5,000 worth of losses, I'm also gonna take my best stocks like, let's say Apple and Disney and Johnson & Johnson, and I'm gonna sell off up to $5,000 worth of profit. So I'm gonna try to match the two. What that does is it cancels out all of the profits and the losses, which means I don't get to pay any taxes, but I also don't get any tax benefits this year either. So why is that good? It's good because as soon as I cancel everything off, I'm gonna wait a month and then I'm going to rebuy all of those best performing stocks that I sold to begin with. That's Apple, Disney, Johnson & Johnson, whatever I want to do. So as soon as I rebuy them, what I've effectively done is increased my cost basis. And why that's good is because imagine a graph, right? You pay taxes on the difference between the price you buy a stock and the price you sell a stock. So when I bought Apple, let's say 10 years ago, I bought it for a very cheap price. So it was way down here. So now 10 years later, when I sell it at a profit, I don't get to pay taxes, which is awesome. And when I rebuy it at that higher price, that means I've closed and narrowed and shortened the gap between what I bought at and what I will ultimately sell at when I'm old and wrinkly. So I've basically narrowed the gap, and it's the gap where you pay taxes. So I hope that makes sense. That's a free step up in basis, and I'm not going to do this method. I'm gonna do the first method where I just take my tax losses because I'm in a very high tax bracket today, and 20, 30 years from now, I might not be. And at the end of the day, I don't even want to sell my stocks anyway because I'm a dividend income investor, but that's still a super cool concept that now you're smarter because you know what it is. Also, if you want to be a part of those updates, you can join my Patreon, and as soon as I make those sales or as soon as I rebuy anything, I will let my Patreon people know, but the value is in the spreadsheet itself, which by the way, I'm trying to convert into an app, and it's going to be super cool. I'm super excited for it. So the overall takeaway, it's a perfect storm of 4 asset classes contracts expiring. So we are peak storm on December 18th. So don't be afraid, but if you want to get started with investing, you can get some free stocks from Webull by depositing $100. Some of those stocks could be valued up to $1,600 each, and you can get another free stock from Robinhood. Love you. Thank you so much for watching my video. You can join my free Discord group, follow me on Instagram, I post from time to time, or reach out to me. My PO box is down below. Love you. Thank you. I'll see you soon. Bye-bye.